Now, for the next section, you just really need to learn some basic terminology here. So you're certainly not going to be asked to do any sort of calculations or anything like that. You just have to have a general idea of what's happening in terms of how we charge IHT. So during your lifetime, you've got two types of transfer. So any transfer is something that's not exempt, i.e. you're not giving it to a charity, you're not transferring something between husband and wife. Now, there are two types of transfers you can make. You can either transfer something to a trust, which is a chargeable lifetime transfer, often referred to as a CLT, or transfer to an individual, which is referred to as a PET, potentially exempt transfer. So with a CLT, this is where a person is putting some money into a trust. So it's the example I gave you earlier. You know, you might put some money into a trust where your grandchildren get the money at a certain age and it gets distributed, but they can't touch it in the meantime. Now, if you pay some money into a trust as the individual, it will be charged immediately at the time of the gift. So you do have to pay tax straight away. So it might get taxed during the lifetime, and then it might get taxed again at death if it falls in that 7-year period. If it falls outside the 7-year period, then it just gets taxed at the time of the gift. Now, in terms of who gets taxed on the gift, that will be agreed. So if the tax is paid by the donor, so the donor is the person making the gift, it's charged at a rate 20/80, which is 25%. If the tax is paid by the trust, i.e. the donee, the person that is getting the gift, then it will be taxed at 20%. Right? But please don't forget, if it does fall within the 7 years prior to death, it's going to get taxed twice. So what we've got here, we've got an individual putting some money into the trust. If the donor pays the tax, then it's 25%. If the donee pays the tax, then it's 20%. And it does say here that you always assume the donor, the person making the donation, will pay unless told otherwise. But as I say, you're not going to have to do any calculations on it. You just need to have a general idea. Now, there's a bit more detail about this here. It says if the donor or transferor also pays the IHT, then this is going to further reduce the estate, isn't it? So if I give some money into this trust, let's say I gave the trust £10,000 to be distributed at some point, and I've also, so I'm the donor, the trust is the donee, let's say I've also got to pay the tax, I've got to pay £2,500 tax. So the value of my estate that's falling is 12,500, isn't it? I've got 10 grand going into the trust, plus I've got this tax bill of 2,500. So that's really what it says here. When the donor pays the tax, the value of the transfer will be the original value that I put in, plus the 2,500, because that's what my falling value of my estate is. My assets are going to fall by 12,500. Whereas if the donee pays it, then my estate will only fall by 10 grand, won't it? Because the person that's paying the tax will be the trust. They'll pay tax at £2,000, but that's not coming out of my pocket. That's coming out of the pocket of the person that's getting the gift. So as far as I'm concerned, the value of my estate falling will just be the original transfer value. So as I say, you don't need to do those calculations, but it might help you to sort of have some numbers there to understand really what's going on. The other type of gift that you can have, so let's number these. Oh, we've numbered that one. Chargeable lifetime gift is your pet. Now, this is not cute and furry things. It's a potentially exempt transfer. So it's where an individual gives something to another individual. So a parent might give something to a child, a grandparent might give something to a grandchild, you might give things to brothers and sisters. Now, when the gift is made, it will be exempt from IHT. So it's not like the trust where tax gets paid immediately. and it will continue to be exempt as long as the person that transfers the gift survives another 7 years. So that's why we say it's called a potentially exempt. So if you survive 7 years, no tax at all. It's only if the transferor doesn't survive 7 years, that the tax has to be paid. So this is all about timing, trying to give your estate away before you get too close to your death, which I know again sounds quite depressing, but it is a way of avoiding, you know, high taxes if you've got a large volume of your assets. So this is quite a nice little summary. If you've got a CLT, it gets taxed in the lifetime. So depending on whether it's the donor or the donee, it will be 20 or 25%. And then it will be taxed again if you die within the 7 years of the gift at the death rate, which is 40%. With a pet, it's exempt when the gift is made, and it will only be chargeable if you don't survive the 7 years. And then again, that will be at the death rate of 40%. Now, there are some small exemptions in terms of what you could transfer. So you could transfer a small gift, and you're allowed to transfer £250 a year, but you cannot exceed £250 to the same donor. So what some people think they can get away with doing is doing lots of small amounts that are all under the 250. Well, once you hit 250 cumulatively, then it's not going to be exempt any further. Normal gifts out of expenditure, as expenses out of income are allowable. So, you know, if you agree to pay for, so say, your grandchildren's education, maybe you're giving them money for Christmas and birthdays, that's perfectly acceptable, because that would just be, you know, a normal transaction. There's no intent there to sort of give your estate away as such. If you give some money away for a marriage, the first £5,000 given by a parent is exempt, and if it's anybody else, within reason, it's £2,500. And then if it's just generally, you know, other people that you're not sort of related to, then it's limited to £1,000. But it is subject to the marriage taking place. So if the marriage didn't take place, then it would be taxable, I'm afraid. Although I would imagine that you'd be asking for your money back at that point. Like all the other taxes, you do get an annual exemption. So the first £3,000 in value of the year is exempt. And strangely, unlike any of the sort of other exemptions we've got, any unused annual exemption can be carried forward for 1 year only, after which it will expire. And it can only be used after that year's annual exemption. So if you carry, say, £3,000 forward to next year, you don't get to use it until next year's allowance has gone. So, for example, if, say, I don't know, 18, 19, you had no gifts at all, you could carry forward your £3,000 to the following year, which would be 1920. If, say, 1920, your gift came to, say, £4,000, you would use the annual exemption from that year first, and then you'd get to use the brought forward figure, okay, to bring the gift down to zero. So you can't use that first, which would make more sense, wouldn't it? Because you can only carry it forward for 1 year. So I'd get to use 1,000 of that next year, and then the balance I've got, which is 2,000, would be lost. There's nothing else I could do with that. All right, so that's what it means when it says you have to use that current year. There's a little bit there about tax payable during the lifetime. So this 7 year period, you do get to look at this nil rate band, which means anything under 325 at the moment is taxed at 0%, so no tax to pay. But this is not really something to be worrying about at this stage. I would just remember, if I was you, that there is this 7 year rule, and it means the pet is exempt, or if it falls in the 7 year period prior to death, it becomes chargeable for the first time. With the CLT, it gets taxed during the lifetime at 20 or 25%, and then it gets taxed again at death if it falls in that 7 year period. So I'm going to finish off with this little example just to explain how that annual exemption works. So we've got a number of gifts here. First thing I'm going to do is right next to the son and the daughter is they are pets. All right, so they will not be taxed in the lifetime, but the trust would be chargeable lifetime transfers. Now, when we're looking at IHT, we're considering what happens in each tax year. So remember, we're looking from the 6th to the 5th of April. So if we look at the first two, August and October 16, they fall in tax year 16-17. They fall between the 6th of April 16 and the 5th of April 17. Then we've got the next two, May and November 17, and they fall in tax year 17-18. And then the final one we've got, which is in May 18, that's going to fall in tax year 18-19. Now, you're looking at a number of years. IHT has really been the same for many years now in terms of the rates of tax, etc. So don't worry that it does go across different years, and we certainly wouldn't expect you to learn lots of rules anyway. So what we're going to do then is we're going to look at these side by side. So in 16-17, the first thing that happened is that you had a pet, and the pet was for 600. So that will be cleared by the annual exemption for 16-17 to 0. All right, remember the annual exemption you've got is £3,000. The next thing that happened in that year was that you had a trust, so that's a CLT. That was for 800, and that would also use your annual exemption. So neither of those would actually amount to anything because the annual exemptions wipe them out. So the annual exemption to carry forward would be your 3,000 minus 600 and 800. So that will give me a balance there. What we got there, 14, can't add up here. So what we got, 1,400, 1,600, isn't it? Then we have the tax year 17-18 then. First thing that happened in that year, we had a CLT for 2,100. We have to use the current year annual exemption first. So we don't look at this. We say, right, current year, that's gone down to 0. The next one that happened that year was another trust, so another CLT, and that came to 1,100. Now, we've only got £900 of this year's annual exemption because I've used 2,100 and I've only got 3,000 altogether. So that will reduce that to 200. So then I'm going to use my annual exemption from the previous year that's brought forward. I only need 200 of it. So 200 is going to get used and 1,400 of it will get lost. Okay, because I can't carry it forward for more than 1 year and I'm not allowed to use it first. The final year we've got there is 18-19. We've got a pet, which is 5,000. 18-19. We've got a pet, pet of 5,000. Annual exemption for the year is 3,000. And I haven't got anything brought forward because I used all of 17-18 and that has now expired because it's gone past a year. So the amount that's chargeable, unfortunately, is £2,000. Now, all of these come to 0 eventually, as we can see with the annual exemption. This is the only one that's got a positive figure at the end, but it is a pet. So no tax yet because it's potentially exempt. That 2,000 will only become taxable if the person doesn't survive 7 years. And when we say 7 years, it's from that date there. So if they live beyond 7 years from May 18, then that 2,000 won't get taxed. But if they don't survive, then that will be taxed at the death rate of 40% if their estate exceeds that 325,000. Now, the final page you've got here has got really a summary of how we approach IHT. Just the general idea is you work out the transfer value. So like the first example, thinking about what the loss in the estate was. In these examples here, they told us what it was worth, so we didn't have anything to do there. Then we look to see if they get any exemptions. So was the gift given in marriage, in which case who gave the gift, how much can we deduct? Do we have annual exemptions for this year, i.e. the £3,000, and is there anything brought forward from last year? If we have any chargeable lifetime transfers, then it's only on anything exceeding that nil rate band, and it will be taxed at 20 or 25% depending on who pays the tax. And then finally, calculating that gross value. But I do want to point out that it does say here, this is not going to be examined. So I don't want you to worry about this here at all. I just want you to have a general idea of what is a PET, i.e. individual to individual. What is a CLT? It's when you give it to a trust. The idea of using your annual exemption in the year first before you use your brought forward, like we had in that second year. And then finally, knowing some general ideas of the sort of things that can give you exemptions. So this could be a multi-choice question. You know, they might give you a number of transfers and say which of the following would be potentially exempt transfer, i.e. which of these might you have to pay tax on. So the one might be the gift of £250, one might be a gift for a marriage, one might be, you know, below the annual exemption. So those are the sort of things you might get in a multi-choice. So just to reiterate before we finish this, CLTs is a gift from an individual to a trust. They are taxed in the lifetime at 20 or 25%, depending on who receives the gift and who agrees to pay the tax. And it may be taxed again at the death rate of 40% if the donor that gives the gift away does not survive 7 years. With a PET, we're dealing with an individual to an individual. It will be exempt when the transfer is made, but we must calculate the value of it. And if the donor does die within 7 years, then that will be subject to taxes. So don't spend too much time on this chapter. It is quite a detailed topic area, but you are just expected to know the basics on this. Any sort of complex calculations don't get examined until you get to the more advanced level.